Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my former colleague and friend, Patrick Furtaw. Thank you, Patrick, for joining me on our Fortuna Advisors podcast, Create More Value.
Thank you for having me, Greg.
Patrick has had many roles and has led important projects in key strategic areas, including organizational design, sales compensation, performance measurement, capital allocation, and what we will primarily be discussing today, revenue model innovation and pricing frameworks. His background in strategy, corporate finance, and organizational change from both strategy consulting and corporate roles provides valuable experience in driving successful outcomes. We worked together at Stern Stewart, where Patrick worked from 1995 until 2012. I still remember a call coming in from Japan, and the caller only spoke Japanese. Our receptionist asked if anyone spoke Japanese, and Patrick raised his hand. One thing led to another, and he opened our Tokyo office, working with many leading companies. To this day, Cow Corporation still has an EVA page on their website, something Patrick must be very proud of. Over the following 10 years or so, Patrick worked at Karl Storz Endoscopy and then Intuitive Surgical. Since then, he has been an independent consultant. Although he has had many responsibilities in these roles, it was his work in pricing and revenue model development that led me to invite him to join me today. So, Patrick, why should pricing be on every executive's agenda, and what is the cost of leaving it unmanaged?
Pricing should be on every executive's agenda, Greg, because it's probably one, if not the most powerful and immediate impacts or levers for increasing pricing and thus shareholder value. I think if we think shareholder value and we just use a proxy of ROIC for a second, really pricing is a primary driver of return.
Mm-hmm.
So if a company return in the ROIC, right? So if a company is focused on increasing shareholder value, then by definition they should be focused on pricing. I would also just say that pricing has a uniquely disproportionate impact on the bottom line. McKinsey's famous for having done a study in 2003 called The Power of Pricing. And in that, they look at the S&P 500 and they take the average operating profit margin, which was around 12%. In fact, I looked in 2024, it was also 12%. If you have a 1% price increase and price goes directly to the bottom line because there's no incremental cost, that's just over an 8% increase in operating profit. In real world, I worked with a client on a pricing project that was a distributor, and they were working with a 5% operating margin. So a 1% pricing increase was a 20% increase in operating profits for them.
Mm-hmm. Mm-hmm.
But to the second part of your question, what's the cost of not managing pricing? And it's really the flip side of that study that I shared, in the sense that just even a 1% decrease in pricing can wipe out 8 to 20% of profits.
Mm-hmm.
So clearly pricing has a lot of leverage, and I think for executives, the question they have to ask is, can you afford not to have pricing as a strategic priority?
Mm-hmm. Yeah. I mean, I stumble on many companies with ineffective pricing strategies. I can't tell you. I mean, it's the majority of companies, I would say. So this topic is very important for companies that want to create more value. What would you say are the biggest obstacles to better pricing strategies?
For me, and you see a lot going on across different companies, probably the biggest obstacle is lack of senior executive leadership or ownership, I should say, of pricing.
Mm-hmm.
If you don't have, an executive to emphasize pricing and pull it through the organization from product development to operations to commercialization, pricing tends to remain fragmented.
Mm-hmm.
and really suboptimal.
Mm-hmm.
So I think that's one. And another common one is companies relying too heavily on cost plus pricing and not connecting prices to the value that customers receive. With cost plus pricing, if somebody does have unique or true differentiation, points of differentiation, they go unrecognized in a cost plus framework. The third one is just generally pricing discipline. So companies that see unplanned discounting, it's typically because they don't have the guardrails in place. Um, that can also include sales compensation not being aligned or being misaligned with pricing. And then I would also just call out pricing metrics.
Mhm.
So companies that haven't really engaged in the pricing journey typically aren't reporting metrics that you'd want to report. And think about price impact. So this is the part of revenue that comes from pricing.
Mhm.
Do we know for our major products or segments how much pricing is impacting revenue increases or
Uh-huh.
declines?
Mhm.
Another practical one, and actually one of my favorites, is price realization. This is the ratio of actual price to target price,
Mhm.
um, and it's standardized at one, so you can compare it across products.
Mhm.
And so if you're, if senior management is not tracking metrics like that and related margin impacts, it's hard to envision how you can drive pricing.
Mhm. Mhm.
And then the last one that is really important. So there's value creation, and then there's value communication. And you see a lot of companies that have not invested enough to equip sales reps with the value narrative. So they're not able to communicate the value.
Mhm.
And so they're not able to defend price. And I think, the good news is that for companies that haven't engaged in pricing, just addressing those five things would lead to a material impact in pricing in the way you go to market.
Yeah.
So I think those are the most common obstacles, Greg, that I think of.
Yeah, that's really good. You talk about cost plus pricing. So years ago, I did an analysis in the early '90s of the Boeing Corporation, and Boeing at the time was they were producing 747s, which had basically no competition as far as distance and number of passengers, and a lot of other planes, and then they had a big military operation as well. And based on work I did using research analyst reports, I was able to kind of identify, roughly the profitability of the different types of aircraft and different parts of the operation, and sort of allocated cost and capital, and more than 100% of the economic profit of the whole company came from the 747. Everything else wasn't collectively wasn't covering the cost of capital, and it was a rough analysis, so it might not have been precise, but certainly most, if not all, of the economic profit was coming from that one plane, and the reason was because they could price it very high because it had no competition. It was very differentiated. It had unique things that it could do that no other plane could do, and a lot of companies, to your point, just you do cost plus pricing, and they would have priced all the aircraft the same and they wouldn't have made anywhere near as much money as they should have on that unique and very differentiated offering of the 747. And they wouldn't have sold enough of all the other planes because the prices would have been too high. There are big problems with cost plus pricing that I think most people just don't even think about it. So we share a belief that incentives play a big role in shaping behavior. We've designed incentive plans together in the past, and this is as true in a sales organization as it is anywhere. Please explain what you mean by fixed sharing commissions versus fixed commission rates.
Sure. I think for salespeople, I've worked with a lot of salespeople over the years, and these are sophisticated people and they're highly motivated.
Mhm.
And how you compensate them really drives behavior. So you need to be really thoughtful about it. And traditionally, what you see with a lot of companies are fixed rate commissions, typically based on revenues. So just a simple example: if I'm selling a product for $10,000 and my commission rate is 10%,
Mhm.
I'm going to receive a commission of $1,000. And actually, those plans work really well when pricing is standardized,
Mhm.
meaning there's no differentiation in pricing. It's fixed with the client and there's no opportunity to discount. The problem with that type of plan is that when discounting comes into the picture, they can quickly become misaligned. And what do I mean by that? So a quirk of revenue-based commission rates is that they're also, in effect, gross profit commission rates because gross profit comes after revenues.
Mhm.
And so the problem is if reps discount, what will happen is gross profit will drop by more than the rep's commission rate. And so effectively what happens is the rep gets a higher sharing percentage. So they've done something that's not necessarily good for the
Mhm.
company in discounting and lowering profits, but they're getting a higher share of those
Mhm.
profits. So it's not fixed. And conversely, if I'm a rep and I'm able to get a premium above target price, the gross profit's going to rise more than my commission rate. And so I've done good behavior
Mhm.
and I'm getting a lower sharing percentage.
Yeah.
So I think the way to address that is to ensure that reps get a fixed share, if you will, of gross profit.
Mhm.
And you can do that by either making gross profit the metric in their plan, so they're getting a commission of gross profit,
Mhm.
or if as a company you don't want to disclose your margins, which a lot of companies don't in today's transparent
Right.
world, you can use a revenue-based plan adjusted by price realization, which again is the ratio of the actual price received versus the target
Mhm.
price.
Mhm.
And so that if a rep sells at target, so they sell at 10,000 in my example, then their commission is 10%.
Mhm.
If they discount to 9,000, what would happen is the commission rate would adjust based on the PR. So their PR in that case is zero point 0.9.
Mhm.
Say the rate would come down to, instead of 10%, maybe it's 8 or
Mhm.
9. The way it's calibrated is it's calibrated to a fixed share of gross profit.
Right.
And so by doing either one of those, you're ensuring what is a value sharing plan
Mhm.
as opposed to a fixed rate commission plan.
Mhm.
And you create alignment there between the rep and the company. And I've used that
Mhm.
plan, a PR based plan, and wildly effective because reps are sophisticated
Mhm. Mhm.
and they
Right.
immediately figure out how to drive the plan. And so I think for if you're an executive in a company that's seeing unplanned discounting,
Mhm.
I think it's worth checking your plan to see if it rewards discounting, and maybe think about a PR type structure.
Yeah, I would say most plans reward discounting. Most that I've seen reward discounting for sure. I'm curious though, what is there a reason why, if especially where you do using the PR approach, where you've got this variable commission rate to basically mimic a share of gross profit? Have you ever thought of? I'm sure you've thought of. Have you ever done it where you actually go a step further and allocate all the costs to get down to operating profit per product, so that the slope of the curve becomes even steeper, basically, on the as the price realization changes, the sharing percent of revenue changes even more rapidly, or is that too complicated?
I do think there's a trade off, Greg,
Hmm.
in complexity, and it just depends on what the company's level of sophistication is. I think just so just to change pricing in a company is a big deal,
Hmm.
but to have access to sales compensation as well
Hmm.
is really unusual
Hmm.
to do those at the same
Hmm.
time. And then when you do them in the real world, I think you have, I want to say limited degrees of freedom.
Hmm.
How much can you change without being too
Yeah.
much? But it's interesting and it just goes further along the same line, right? So I think if you're designing a plan from the get
Hmm.
go, that's an interesting approach.
Yeah. Yeah. So we touched on cost plus pricing before. Many companies, of course, target an operating profit margin. I have a really good story on that, but I won't belabor it at this point. And this implies a required gross profit margin, and then they use cost plus framework for pricing. Adding X% to the total or marginal cost per unit. So what's wrong? Can you give me more specifics on what goes wrong with that?
I think the cost plus pricing, it is widely used. And I think actually, if you see the surveys, probably more than half of companies are using that as their approach. And what's really crazy about it is cost plus pricing is an internally focused approach.
Hmm.
It basically says, hey, our costs are this. We want to get, we got to cover our margins as you described.
Hmm.
And so the markup is this.
Right.
And what that misses completely is what value customers receive. It just doesn't look at it. And so if you have a product that's highly differentiated that a customer perceives to have value, they may be willing to pay more, but you're not going to, it's basically going to be missed and unrewarded because you're using costs and not value. I think in pricing, the probably the most important aspect of pricing is value and value to the customer specifically. And even within that, it's really the customer's perspective or perception of value, right? If a customer perceives there to be high value, their willingness to pay goes up. And if they perceive there to be lower value, willingness to pay goes down. I think what's interesting is if you look at the new revenue models, you look at the tech companies that, and I'll give a couple examples, actually their trend is towards value. Because when you're offering a model that the customer can, leave at the end of each month if they want to, if they don't see value, you better have a pretty strong value proposition. And so Salesforce.com, which was one of the earliest of the SaaS companies, historically have positioned their pricing against the incremental revenue that customers earn from using their CRM platform. So it's value based, which is good because if they charge on a cost plus basis, the marginal cost of software is very low,
Yeah.
as we
Yeah.
know. It would have no representation of value to the customer. And then, Apple's probably another story where the hardware that Apple sells is comparable to competitive hardware, but they get a real premium for it because of the design and say the ecosystem benefits, the App Store, and just the brand. But what is that? I mean, that's pure customer perception
Yeah.
and has nothing to do with costs
Right. Right. Right.
for Apple. And that's where you want to be. And I think that's where the world is trending as pricing becomes more sophisticated and the new revenue models
Mhm.
start to permeate beyond tech
Yeah.
into the industrial world.
Yeah. From a personal point of view, I had an interesting experience with this with my dad a few decades ago. There was a period of time when the breakfast cereal industry sort of realized that they were underpricing their product. And in a pretty rapid, period of, 3, 4, 5 years, pricing doubled without a heavy amount of inflation. And one day I was at my dad's house and he complained about it. He said, there's no reason for this. Their costs haven't gone up. This, talked about them like they were, devilish people. And I just looked at him. I said, you keep buying it, right? And he said, yeah. I said, well, it's still like pretty cheap for the number of breakfast meals you get out of one box of cereal per meal. You're still spending very low money, right? He said, yeah. I said, so I guess they figured that out. And they raised the price because they realized it was worth much more to you than what you were paying for it. And he just grumbled and, kind of walked away from me. But, I think that, that to me, these little things that happen in your life just leave a mark on you, right? In terms of how you, sort of think about things. But anyway.
Yes.
So you told me about one situation where there was a wide range of price realization. What were the drivers of this? And is it good or bad to have a wide range of price realization?
I mean, just to mention again for your listeners or viewers, that price realization is taking the actual price divided by the target price. It's a ratio. So if you sell at target, it's one. If you sell above target, it's greater than one. And if you sell below target discount, it's less than one. So envision a left skewed frequency distribution with all the deals to the left of the target price. Generally, that's a red flag
Right.
that you're leaking profit. And some of the most common cause of that is that companies don't have in place the appropriate guardrails around pricing. So reps may have authority to discount, but don't necessarily have the controls in place. Part of that, things like a deals desk that handles exception pricing or handles large deals pricing. But also a big piece of that is compensation. So is the sales compensation aligned? Does it hold discounting accountable and does it reward price realization? I think that's one of the causes. And then the other big cause we touched on a little bit is sales enablement. So sometimes what you see are these patterns where some customers are paying full price and sometimes even a little bit of a premium. And then other customers are getting steep discounts. And when you pull that apart, what you see is you have reps that maybe they're more seasoned. They really understand the value story and they're able to hold price and defend price. Whereas weaker reps that aren't able to communicate the value, they give price away. And so again, the solution for that is investing in equipping reps with the value narrative and any tools, ROI calculators, those types of things they can use to show the value to the customer.
Yeah. We had a situation with one of our clients last year or the year before, maybe, where they were getting a lot of pressure on terms, receivable, time to pay from 30 days to 90 days and even more. And every time it happened, it would elevate to corporate finance and they would either approve it or not approve it. And, that was sort of it. And sort of like you just said with giving people tools, we developed a little simple tool that basically said, well, if it goes from 30 to 60 or whatever it goes to, you put it in the number of days, it would show you how much the price would have to go up for you to be, sort of neutral to it. And they weren't always able to go back and get the price that would normalize it, but they almost always got some more. And, in a rapid period of time, the sort of benefits that they realized from using this model during when they were negotiating prices, paid for the project we did like 50 times over. I mean, it was just phenomenal how much some clients chose to say, okay, we'll pay in 30 days. And some clients chose to pay a little bit more, maybe meet them halfway or something like that. And so sometimes they still suffered versus the status quo previously, but it was still better than what they were doing before they had this model in their hands. So yeah, that's a really,
It's a really good example, right, of equipping the sales rep with a way to communicate the value
yeah,
or the narrative is give them calculators.
yeah.
And I think absolutely is one of the most tangible ways to help sales reps because you give them something they can use.
Um,
And by the way, the customer can then use that to share with the purchasing department
mhm.
or their supervisor.
Yeah. It's just one more aside on this. You mentioned economic profit in one of your early answers to my questions. We of course implement a form of economic profit with our clients, and people often say, "Oh, I don't know, people it's too complicated. People won't understand it, and so forth." But if you take a salesperson and you change the way they're paid, the way you were describing before, and you give them a calculator like this so that they know how to make these trade offs and so forth, you don't have to teach them all the financial theory behind why you're measuring this economic profit measure the way you do. You want to teach them the basics of it. But what you really want to teach them how to do is how to use that calculator, so they know how to make the specific decisions that they make. And I really haven't had an experience in over 30 years of doing this where you couldn't teach people in any department of the company about these things. It's really not that complicated if you focus on the decisions that they make.
Yeah, and they're very much appreciative of having those because it lets them do what they do.
Yeah, yeah. So what happens if the sales organization controls pricing versus if finance controls pricing? And I guess related to this, who do you think should control pricing in an organization?
It's interesting. I think there's a perception that if sales, it's, I should first start by saying it really depends a lot on the company and even those functions within the company. So I think there's a perception that if sales controls pricing, that discounts will increase, and that if finance controls pricing, that perhaps pricing is going to be too rigid or it won't be customer oriented enough
Hmm.
because they're removed from the customer. And I think probably both of us have met salespeople that really understand value
Hmm.
at the PhD level
Hmm.
and don't discount, and also finance people that are incredibly customer centric. But I think the gist of the question is there a risk of any one function dominating pricing? And it's interesting because, Greg, over the last 10 years, a lot of, particularly the larger companies, have created dedicated pricing functions.
Hmm.
And so you'd be able to say, okay, well, let me just, where do they sit in the organization? And what you see, I've seen them sit really everywhere. I've seen sales, finance. I've seen dedicated revenue operations group that run pricing that report directly to the president or the CEO.
Hmm.
I've seen marketing. I've seen strategy, and I've seen pricing groups go directly to the CEO.
Hmm.
And I think it really is idiosyncratic to the company.
Hmm.
But I still think the question is shooting at how do we ensure that it's properly governed?
Hmm.
And a common structure that you see, it's another tier. So separate from the dedicated pricing group, a lot of companies have created pricing committees.
Hmm.
And on the pricing committee are the heads of the key functions. So finance, sales, product, and the head, if there is a dedicated pricing function, the head of the dedicated pricing function.
Hmm.
And actually, that committee will make major pricing decisions. But what they'll also do is set policy.
Hmm.
And then they'll delegate the authority for that policy to a pricing function or to whoever controls who's ever driving pricing.
Hmm.
But I think the benefit of that is that having that governance where all of the major functions that are impacted have a forum to chime in on pricing and really discuss pricing.
Hmm.
And that's a company that really understands the
Yeah.
value of pricing, and they're going to dedicate that time because it's one of the most important things that they could do.
Hmm.
And so I think that works really well. And I think otherwise companies sort of need to experiment, but that's a really nice way of driving pricing through the organization.
Hmm. Yeah, I think when you have a dedicated group like that and you have quite variable, price realization, the other thing they can do is gather data, right? They can keep track of all the data on all the pricing, and they can look at win rates, win loss rates at different price realizations in different circumstances to try to use it to sharpen the pencil. If you're winning everything, even at 105% of your target price, your target price is too low, right? Yeah. So that's when it's scattered, when the function is scattered, you don't always collect that data and have anybody really looking at it.
I think so. And Greg, I would just say that typically, so to your point, a dedicated pricing function, one of their roles, besides new product pricing or price changes or contract management,
Uh,
is to really be the factory for pricing analytics
mhm,
and insights that go to the pricing committee, or that they should be on executive dashboards.
mhm,
Again, so that they can see what are the trends and be discussed.
mhm, mhm.
Because without that, it's really hard to drive pricing.
Yeah, that's good. That's a really good point. So you mentioned tech before. So there's a lot of buzz about subscription models. Anything as a service these days, often seen as extensions, of course, of SaaS. But what's really driving this conversation, and how are revenue models evolving across industries?
Sure. It's a really interesting time, Greg. And you and I have talked about it a little bit before in revenue models and in technology. So clearly, the SaaS companies wrote the book for how to transform a business from a one-time upfront sale or upfront license
Mhm,
to an ongoing service business. And the software companies were able to do that uniquely because of their product was software.
mhm,
So they were able to offer a service in the cloud, but also in software, they understood the customer, right? Because they see what the customer is using in real time all the time,
mhm,
which is not true of industrial companies.
mhm,
A lot of times, once you sell a product, that's it.
mhm,
You don't know what's happening with that product afterwards.
mhm,
And so they certainly set the trend, and customers absolutely appreciated it. But there's really, I mean, there's benefits for customers, but there's also benefits for
mhm,
providers. And if you look at the customers, actually, let me just say the SaaS companies got it sort of kicked off, but now the technology is expanding. So now technology exists that allows industrial companies to start to track usage
mhm,
and outcomes of their customers. So now all of a sudden they have the ability to actually create models similar to the SaaS
mhm.
models. And that's what you're starting to see. And even the industrial companies now, and maybe I'll talk an example in a minute, are doing that. And so clearly there are benefits. So for the customer, the benefit, obviously, the one is instead of an upfront expenditure,
Mhm.
they have smooth expenses over time that they can plan versus a one-time capex or a one-time license fee. So it smooths things out. But also when you do that, you eliminate a lot of financial risk. So if I had acquired that license, but then I don't utilize the software, or I buy this piece of equipment but I don't utilize it, the risk is on me
Mhm.
as the purchaser.
Right.
And now the tables are turned a bit because the provider or the company giving you the service wants you to continue.
Mhm.
That's their value.
Yeah.
So their incentive is absolutely to make sure that you're engaged and that you're seeing and using the
Mhm.
value, or else you won't renew.
Yeah.
So that's the benefit. And then I think the other thing is you're starting to see like usage metrics. If you think of Amazon Web Services, there are different models, but think about the usage.
Mhm.
And that's what you're paying on. And as a customer, when you're paying on usage, the value is clear. Yes, that's what I'm paying for. It's aligned directly with my business. And some products that aren't like that, when you just buy one piece of capital, sometimes you struggle to get the value. And then outcome metrics as well. So people start to track different outcome metrics, and maybe even pay based on outcome
Mhm.
metrics.
Mhm.
And so it's very powerful. So the technology is there, and industrial companies are starting to use it.
Mhm.
I would say that the clear value link, I got continuous sort of alignment, and then just that risk sharing that's inherent, and that the providers, the risk is on them now
Yeah.
to make sure it works. And then I think from the provider's perspective, recurring revenues.
Mhm.
You know, everybody wants a recurring revenue stream,
Mhm. Mhm.
and why is that? It's better for your business. It's easier to
Uh-huh.
plan, and investors actually reward recurring revenue at a higher valuation
Mhm.
than one-time
Yeah.
sales because it's a better business
Yeah,
model.
for sure.
But then I think the other piece is if you're working with a customer and you're seeing their usage every day, it's easier for you to start to innovate, and you can see where the problems are. And now all of a sudden you can bring more value to the customer.
Mhm.
And assuming that value delivery, the lifetime value of that customer goes up,
Mhm.
right? And the revenues and cash flows increase.
Mhm.
So in essence, it's kind of a win-win. And I think for companies that haven't engaged in pricing yet, it's a good time to get in because it's moving very quickly, and you're going to see evolution in revenue models that become value propositions in and of themselves, right? Because they're true
Yep.
differentiators. And the sooner you get in, the better, because it'll be harder to catch up if you wait too long.
Hmm.
Pricing and revenue models, it's a revolution right now. With I think I've seen a headline, the recurring revenue revolution. It's a revenue model revolution
Yeah.
that's taking place.
Yeah. No, that's,
And sorry, Greg, the one example I wanted to give was John Deere, right? Which people think of as tractors
uh
and farm equipment, but they've attached to that equipment. Now, when you buy that equipment, you also get access to a software platform that will help you on your planning schedule, that will help you on your crop yield,
hmm
and they'll even, in some cases, link their pricing to improvements in crop
hmm
yield. And so all of a sudden, John Deere is not just a capital equipment, but they're providing a
hmm
service, which is really, in some ways, it's like an innovation
Yeah.
platform because you're with your customer every day,
uh
and that allows you to bring so much more value than you ever could because you had no idea how the equipment was being used in reality. And so it's a huge change,
hmm
and I mean, I think it's really just for industrial companies, it's really just getting started.
hmm Yeah, I had a similar conversation with on my episode with Andrew Bonfield from Caterpillar, a competitor of John Deere, about putting information gathering devices on the equipment. They charge a very small subscription fee, and then they can provide advice on when to change a belt, when to change oil, maintenance
Yes.
things and so forth. So the equipment has a higher uptime because it's properly being maintained, even if it's being maintained by the user, and that makes them
Yep.
more happy with the
Value.
service, and they know more when the person needs a replacement because of the feedback that's coming back, and so forth. So yeah, I think in lots of industries, people really aren't thinking enough about these kinds of pricing tools to not just get the stable cash flows that come from a monthly uh, uh, you know fee, but also that information that allows you to actually serve the customer better, which is an important part of getting price to begin with.
Part of it, Greg, is also just a lot of capital equipment has been commoditized,
Mm.
and you have low cost providers coming out of different countries,
Mhm.
and adding software and value, as you just described, and as John Deere is doing, takes you out of the commoditization trap
Uh-huh.
and brings you into providing value to the customer that they're willing to pay for. It's a completely different model, and it's going to be really interesting to watch from this point.
So my last question: Amazon does a lot of price testing, and they use the sales data at different price points to understand the price elasticity curve, which is very helpful in setting optimal pricing strategies. Most of the time, when I ask people what is the elasticity curve on your products or services, they look at me like I have four heads. Like, how are we going to gather that data? But do you know anything about what Amazon does, and or how companies in general approach trying to understand that elasticity?
Yeah. I mean, Amazon they're doing it, right? So their advantage is their massive volume of transactions, right? And then also very sophisticated analytics. So they're able to basically A/B test in real time all the time, and so constantly testing prices, and not just prices. They're testing things like shipping costs, subscriptions, promotions, and then able to put the results back into the algorithm, right away.
Uh-huh.
And I think it comes down to that advantage of having the volume that they have in the sophisticated analytics. And there are other people doing it. Think about certainly Walmart,
Mhm.
Alibaba, sort of the big e-commerce firms. You can think about Netflix,
Uh-huh.
Spotify,
Uh-huh.
and I think it's also Venn diagram with the digital first companies, right?
Uh-huh.
AI driven companies that have the capacity
Mhm.
to do that and the sophistication to do it. The travel companies have long done that with yield management. So the airlines and hotels, think of Airbnb.
Mhm.
And, it comes down to, I think for many companies, the big challenge is having the data.
Mhm.
You think about the traditional industrial companies and B2B companies is they don't have the data, and they probably don't have the sophistication and the analytics. So for them to do A/B testing actually could upset customers
Mhm.
because they could notice it.
Right.
Whereas Amazon can do that in really with a lot less risk.
Mhm.
But I think that the takeaway is not to try to, to think that you're going to get the volume of Amazon necessarily or the speed, but just the principle of testing, learning, iterating, and price is incredibly valuable.
Mhm.
And just, so that's really the takeaway. And as AI comes and as the technology continues on the velocity that it's on, people will have better pricing engines and be able to do this type of thing that Amazon's able to do today.
Mhm. Mhm.
I'd say they're just ahead of the curve along with their digital brethren, but others will come along.
Yeah, I think in whatever business you're in, I think it's worth trying more testing of different prices to gather information. I just think far too few companies really do that in a sophisticated way, in a way that's really thoughtful and comprehensive. So.
Yeah. In a gross way, Greg, just to follow on that. So I think a lot of people learned pricing was really been impacted by three events, starting with the financial crisis.
Mhm.
Until then, I think life, in industries, although it's a generalization, was you raise prices annually and sometimes more than once a year, and life went along.
Mhm.
Then the financial crisis came and you couldn't do that.
Mhm.
And then COVID came. And I think post COVID, with the supply chain problems, a lot of people said, hey, look, we have to raise price. And customers didn't blink.
Yeah.
And there were some very significant price increases.
Mhm.
And then I think people said, well, wait a minute, we haven't been increasing price. And again, I think it comes back to value.
Mhm.
And I think it's just the other piece, a little bit of a tangent on value is in order to raise your prices, if you're a value-based provider, you need to create more value. So it really informs your product roadmap. Yeah, I want to raise price. Well, what can I do to provide value?
Mhm.
And we talk about some of these technology companies, they're constantly innovating
Mhm.
and offering, sort of additional sophistication as they gain it.
Mhm. Yeah, and I think that's the value you provide in a differentiated way that they can't get from somebody else is what enables premium pricing. So I think that's a really important point. That's a good point to close on.
Yeah, there's kind of a phrase. I think it's something like customers don't buy your costs, they buy your value.
Mhm. Right, right, right.
So
That's great. So we'll wrap it up there unless you have anything else you want to say.
no, Greg, I mean, I just think it's a really interesting time for pricing and revenue
Mhm.
models. And for companies, the ROI on pricing is really quite
Yeah.
large. If you talk to companies that have gone down that road, they'll all tell you the story of the returns that they generated. So it's an exciting area to focus on. Thanks, Greg.
Thank you. So,
Appreciate it.
so we've been speaking with Patrick Furtaw. Thank you, Patrick, for joining us for this very important conversation.
Thank you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.